Today, Thursday, January 15th, 2026, they made their play. Look at the chart. Within mere minutes, silver prices collapsed from morning highs near 93 to 86, a drop of nearly 8% in just one trading session. Let's be clear, in a functioning market, a commodity doesn't lose 8% of its value in minutes without catastrophic news. No mine collapse, war resolution, or groundbreaking discovery of a new silver deposit occurred today. So what changed? The fundamentals held steady. Industrial demand didn't evaporate. The Shanghai price remained intact. What happened here was a classic paper raid. The respected KBC letter has already published an emergency update describing the volatility in commodities as truly incredible. They're right, it is. But more importantly, it's not random. This crash was orchestrated, a surgical strike designed to activate stop-loss orders from retail traders who, driven the price up to $92. Banks have visibility into stop-loss positions and know exactly where the breaking points are. Today, they drag the price down deliberately to force panic selling. Why do this? Why suppress the price when physical markets remain tight? Because options expiry looms. Billions of dollars in call options, bets on silver prices climbing, are set to expire this week. If silver settles above $90, banks taking the other side of those calls face enormous payouts. By pushing the price to $86 even briefly, these options become worthless, allowing banks to erase liabilities from their books and pocket the premiums instead. This is purely a survival strategy for them, rooted not in valuation, but in liability management. However, for the less informed investor, this flash crash becomes a trap. A massive red candle triggers instinctive fear. Doubt creeps in. The rally is over. I need to get out. Media outlets amplify this fear with headlines about profit-taking or technical corrections, suggesting the bubble has burst. They want you to focus on the screen price and ignore real-world dynamics. But here's the thing. While the screen showed silver prices plunging to $86, something very different was happening in the physical market. Reports from dealers confirm that the physical price of silver didn't follow suit. Prices held firm. Premiums expanded rather than contracted, and no tangible reduction in pricing matched the paper manipulation. This divergence underscores a critical point. The dip to 86 is essentially a phantom figure, existing only within leveraged exchanges like those in Chicago and New York, and bears no reflection of reality. Selling your silver now, based on that calculated drop, means acting on false information and surrendering your asset to the same entities behind this manipulation. January 15th will likely mark a historical turning point, when paper markets irreparably lost credibility as their disconnect from reality became too glaring to ignore. Instead of discouraging buyers, this engineered drop has created an opportunity, a signal for savvy investors. Consider it. If you're Samsung and need silver for battery production, wouldn't you jump at an $86 price down from yesterday's $93? This is a fire sale, an unintended consequence of banks scrambling to salvage their options positions. Ironically, their actions subsidize further accumulation by industrial players and major buyers in markets that are steadily draining vaults of physical metal. In their short-term focus to cover liabilities, banks are jeopardizing long-term stability, essentially burning furniture for heat. In the next deep dive, we'll unpack how these options manipulations are executed and why this type of volatility, the sharp rug pull, often signals the last shakeout before prices make a parabolic move upward. The screen says $86 because that's what the banks want you to see, but it is not the truth. While algorithms painted the chart red and crashed paper prices, the underlying reality tells a different story altogether. The current situation in the silver market reveals unmistakable cracks in its structure. An 8% drop in the price of any commodity would typically lead sellers to scramble, slash prices, and push inventory to mitigate further losses. Yet, what unfolded with silver after its sharp drop challenges this norm. There were no enticing sale signs. Instead, doors were shuttered. The United States Mint, the federal arm responsible for producing American silver eagles, along with numerous other silver products, officially suspended their sales. Their justification? They need to recalibrate pricing in the face of surging demand. This statement defies logic. If the spot price has crashed and is supposedly low, why isn't the Mint reducing its own prices? Why would they be rushing to reassess amid high demand unless something fundamentally wrong was happening? The Mint should theoretically be flooded with affordable silver supply, benefiting from the dip. But that's not the case. This abnormality sends a clear message. What S displayed as the paper price of silver is irrelevant in the real world. If the Mint cannot acquire silver blanks at the $86 spot price for production, it implies suppliers are rejecting this valuation outright, demanding much higher prices instead. This peculiar phenomenon isn't confined to the public sector. APMEX, a prominent private dealer in precious metals within the U.S., has radically altered its policies in response to the market stress. They have rolled out a jaw-dropping $10,000 minimum order requirement for sellbacks and are clamping down on pre-sale items. Such measures are not designed to streamline operations, but rather reflect a brewing crisis. By effectively sidelining smaller buyers, they're broadcasting one clear signal: there's not enough metal to go around. The imbalance between overwhelming cash demand and dwindling silver supply is pushing their logistics to a breaking point. What's unfolding is essentially soft rationing, an acknowledgement of scarcity without explicitly stating it. Digging deeper reveals the starkest evidence of this broken market: the divergence between paper and physical silver prices. Reports from dealers indicate that while the official paper price sits untouched at $86 per ounce, the actual physical price, the cost for someone to get their hands on silver, hovers at a staggering $120 per ounce. That reflects a $34 premium, or about 40% above the paper price. A typical premium would range between 2 and 3. This discrepancy is a glaring signal that the paper price is detached from reality. The ramifications are profound. The paper price has devolved into a meaningless figure, a relic applied by financial institutions for their internal trading games. Real-world buyers, however, must contend with physical metal prices that remain immune to these artificial fluctuations. An $86 screen price might look tempting on paper, but when dealers demand $120 per ounce, it's clear what silver is actually worth. This mismatch between paper and physical values has also created a massive arbitrage opportunity. Large-scale traders who can buy silver at $86 on the exchange and convert those holdings into physical metal stand to make a tidy profit, reselling it around $120 per ounce. This logic funnel will inevitably drain remaining physical supplies from exchange repositories like COMEX's warehouses. Once that inventory dries up due to arbitrage-driven withdrawals, this disparity will collapse what remains of that fragile market framework. With U.S. mint closures, private sector rationing, and sky-high premiums exposing systemic vulnerabilities, it appears silver is transitioning underground into private vaults, industrial stockpiles, and hands strong enough to hold through chaos. When metals exit public visibility and trade privately, scarcity among retail buyers grows even more acute. Critically, schemes like today's artificial price smashed to $86 aren't demonstrations of market robustness. They're defensive maneuvers amid desperation. Banks may succeed in suppressing paper prices temporarily, but they cannot escape the reality that physical supply demands far exceed what their valuations can provide. If you think it's bad in the U.S., just look eastward. While New York's silver markets nosedive with a gaping disconnect between physical and paper numbers, another divergence is growing between New York prices and Shanghai's stable market stance. The gap between these two markets now exceeds 14 per ounce, a development with implications I'll explore further in upcoming analyses. One thing remains certain. As each new milestone widens these fractures further, vaults will continue emptying at an accelerating pace, both in America and abroad, leaving little for those clinging to outdated ideas of silver as value as determined by paper markets alone. The banks just put silver on a fire sale for the Chinese, and the Chinese are buying every ounce. We have analyzed the man manipulation on the COMEX. We have witnessed the breakdown at the U.S. Mint. Now we must turn our eyes to the east, because that is where the true damage of today's flash crash will be realized. While the algorithms in New York were busy smashing the price to $86 to save their options bets, the Shanghai Gold Exchange sent a message that should terrify every central banker in the West. They didn't sell, they didn't panic, they simply widened the spread. We have confirmed reports that the Shanghai silver premium has spiked to 13 per ounce over the international spot price. While Gloex was trading at $86, silver on the Shanghai Futures Exchange was still changing hands at over $100. Do the math. That is a $14 gap between New York and Shanghai. In the world of logistics, a $14 gap is not a spread. It is a financial death note for the COMEX. By smashing the paper price to $86, the Western banks have effectively put the entire United States silver inventory on a flash sale for the Chinese industrial complex. Think about it from the perspective of a trader in Beijing. Yesterday, you were paying $100. Today, the Americans are offering to sell it to you for $86. Do you think the price is crashing? No. You think the Americans are losing their minds? You buy. You buy everything. This creates a vacuum effect. Every available ounce of silver in London, every bar sitting in a vault in New York is now being targeted for export. The arbitrage profit is so massive that it covers the cost of shipping, insurance, and security 10 times over. The banks think they are saving themselves by crashing the price. In reality, they are accelerating their own demise. If the price had stayed at $93, the drain would have been slow. At 86 US dollars, the drain is a torrent. They are incentivizing the very thing they are trying to prevent, the physical depletion of the West. We call this the paper trap. The more they suppress the paper price, the faster the physical metal leaves. They cannot win. If they raise the price, they go insolvent on their shorts. If they lower the price, they lose their inventory to China. This is why the Shanghai Premium is the most important chart in the world right now. It is a measure of the desperation differential. It shows how much more valuable silver is to a manufacturing economy than it is to a financial economy. China needs the silver for solar panels. They need it for the energy transition. They view it as a strategic resource. The U.S. views it as a ticker symbol to be gambled on. Today's crash proves that the U.S. market is broken. It is no longer a price discovery mechanism. It is a discount window for the rest of the world. And look at the timing. This is happening right before the option's expiry. The banks are willing to sacrifice the nation's strategic reserves just to avoid paying out on a few $1 billion of call options. It is short-term greed leading to long-term ruin. But for you, the individual investor, this divergence is critical intel. It tells you that the drop to $86 is artificial. It is not supported by global demand. If the price were truly crashing, Shanghai would be crashing too. But Shanghai is holding firm. This means the price must snap back. It acts like a rubber band. The further they stretch it to the downside in New York, the harder it will snap back to the upside to meet Shanghai. We are looking at a bear trap of historic proportions. The banks have convinced the retail traders to sell at the bottom, while the whales in the east are backing up the truck. Do not be on the wrong side of this wealth transfer. The $14 gap is unsustainable. It will close, and it will not close by Shanghai dropping to $86. It will close by New York, ripping back to $100. The Shanghai vacuum is now wide open. The sound you hear is the sound of the vaults being swept clean. In the final part of this deep dive, we are going to look at the end game. We are going to bring it all together. The mint suspension, the dealer premiums, and the Shanghai spread. We are going to explain why this flash crash is likely the final shakeout before the market goes truly vertical. And we are going to give you the strategy you need to navigate a market where the screen price is a lie and the real price is unaffordable. The paper price crashed. The physical price exploded. Which one do you trust? We have arrived at the conclusion. If you have been with me through this emergency broadcast, you now understand the full scope of the deception we witnessed today. You understand that the crash to 86 was a paper raid designed to save the banks from options expiry. You understand that the physical default at the U.S. Mint and APMEX proves the real supply is gone. And you understand that the Shanghai vacuum is sucking the remaining inventory out of the West at a record pace. The evidence is overwhelming. It is forensic. It is undeniable. Today, Thursday, January 15th, 2026, will be remembered as the day the silver market officially snapped in half. We are no longer looking at a single market with a single price. We are looking at two distinct realities fighting for survival. On one side, you have the paper world. This is the world of the comics, the algorithms, and the high-frequency traders. In this world, silver is $86. It is volatile. It is crashing. It is scary. On the other side, you have the physical world. This is the world of the U.S. Mint, the dealers, the industrial buyers in China, and the prudent investors. In this world, silver is $120. It is scarce. It is rationed. It is unobtainium. The gap between these two worlds is $34. That $34 spread is the lie. It represents the extent to which the financial system is suppressing reality. But as we know from physics, pressure builds until it finds a release. So what is the end game? How does this resolve? There are only two ways this gap closes. Scenario one, the physical price crashes down to $86. For this to happen, people would have to stop wanting silver. Samsung would have to stop building batteries. The Chinese would have to stop accumulating. The U.S. Mint would have to suddenly find millions of ounces of inventory. Given the fundamental data we have analyzed, the inelastic demand, the empty vaults, the strategic hoarding, this scenario is mathematically impossible. Demand is accelerating, not slowing. Scenario two, the paper price rockets up to meet the physical price. This is the only path forward. The $86 price on your screen is a coiled spring. The further they push it down, the more energy it stores. And when the option's expiry passes, when the banks lift their boot from the neck of the market, that spring is going to release with violence. We are setting up for a snapback that will take us from $86 to $120 in the blink of an eye. The paper market has to catch up to the street price or the exchange will cease to exist. This brings us to the final verdict for the individual investor. I know today was hard. I know watching your account balance drop 8% in an hour is painful. It induces nausea. It makes you question your thesis, or you think, maybe I was wrong. Maybe the banks are too strong. But you have to look at the other side of the trade. When you sold your silver today, if you sold, who bought it? The U.S. Mint didn't buy it. They are closed. The retail public didn't buy it. They are locked out by minimums. The entities buying at $86 are the very same entities that engineered the crash. The banks covered their shorts. The Chinese wholesalers filled their boats. The industrial giants topped off their reserves. They shook the tree and they gathered the fruit that fell. Do not let them have your fruit. The great decoupling is a trap for the weak hands and a gift for the strong hands. If you hold physical metal, the price on the screen is irrelevant. Your ounce is still an ounce. And based on the dealer reports, that ounce is worth $120, regardless of what the ticker says. You're holding the only asset that has no counterparty risk in a system that is failing. The fact that the US Mint cannot price its own currency's coinage is the ultimate signal. It tells you that the dollar is losing its ability to measure value. When the measuring stick breaks, you don't blame the object you're measuring, you blame the stick. Silver isn't volatile, silver is the rock. The dollar is the thing that is thrashing around dying. So what should you do tonight? First, turn off the screen. The price you see is a lie. It is a digital hallucination designed to extract your wealth. Second, look at your stack. Hold it in your hand. Feel the weight. That is reality. That reality is being chased by billions of people and trillions of dollars. Third, prepare for the pivot. The crash to $86 was the problem. The dealer lockout was the reaction. But there's a third part to this story, the solution. The volatility we saw today, the 8% crash, the broken supply chains, has caught the attention of the highest levels of power. The government knows that a broken silver market is a national security threat. They cannot build missiles with paper contracts. They need the metal, and they know that low prices destroy supply. A document that acknowledges the danger of low prices. A document that proposes a floor under the market to secure American independence. The banks are fighting for lower prices. The government is about to fight for higher prices. In our next video, we are going to break down the Trump proclamation. We are going to analyze the executive order that was signed today and why it effectively puts a government price floor under the price of silver. The banks won the battle today, but the war is about to change. The cavalry is coming and they are bringing price controls, not to cap the price, but to support it. The paper game is over. The political game has begun. Hold fast. The real price is $120, and the government just realized they need it to go higher.